Good evening and welcome to Realty Coffee Talk. My name is Tahir Qureshi. I'm a fellow Rules Issuer of Canada, broker of record for City Pro Realty Inc. brokerage, and also principal broker of Canada Express Mortgage Inc. license number 132401. Tonight's topic is the quick analogy, a tale of the two diners. Most recently, Bank of Canada has reduced their key interest rate, and people are deciding whether they should go with a fixed mortgage rate or variable mortgage rate. So tonight's program is to explain you both options so you have understanding of this program. Is being recorded and will be shared on social media. So let's just stop it here. I'm going to present that. So I'm going to start by this program, the quick analogy, a tale of the two diners. So we're going to talk about that, the fixed mortgage and variable mortgage and how this. As you know, I'm a principal broker of Canada Express Mortgage. My individual license as a principal broker is M08002130, and also Canada Express Mortgage fiscal license number 13241. So let's begin the journey of learning. What is the first fixed mortgage rate? It's like a booking, a fixed price, all out, you can eat buffet. You know, when you go to the buffet, all eat, everything is included, there's a fixed price. So you know the exact cost upfront for the entire meal. Regardless of how much the market price of the food changes, it's predictable and safe. That's a fixed price concept. Now, variable mortgage rate is like ordering a la carte from a menu where the prices can change slightly with the market. Sometimes your meal is cheaper than the buffet. Sometimes it's more expensive. It's a gamble on where prices are headed because there is a variable. So we're going to explain that every step of the way. So fixed mortgage rate. A fixed mortgage rate has an interest rate that remains constant for a set period, the term, typically 2 years, 3 years, 5 years, or 10 years. It depends on how you negotiate the deal. Your principal interest payment stays the same every month. Okay? Now, let's look at the pros and cons of a fixed rate so you understand that. Number one, predictability and budgeting. This is the biggest advantage you have. Your housing cost is locked in, making official financial planning simple and stress-free because you have a fixed rate. You're immune to the rising interest rates for the entire term. If you fix up the rate for a period of time, it stays there regardless of what changes happen in the marketplace. Number two, peace of mind. You can sleep soundly knowing that even if the central bank or Bank of Canada raises rate dramatically, your mortgage payment won't change. This provides significant financial and emotional security. This is why you take the pros and cons of what is good. Number three, easier for first-time home buyers, because when you have first-time home buyers, stability of fixed payment is often ideal for those on a tight budget or new to homeownership, as it eliminates one major variable from their monthly expenses. So if you are on a fixed mortgage rate, is fixed. Therefore, no matter what happens, you already budgeted it from the day one when you acquire a property. So you don't have to worry about it, turmoil in the marketplace. Cons of a fixed rate mortgage. So we have a pros and we have a cons. Cons are typically higher interest rate, risk premium. When you are trying to ask lender to fix the rate, lender charges a premium for the security they provide. The initial fixed rate is almost always higher than the initial variable. So basically what they're saying is that cons are you will be paying higher price or interest rate than variable, but you will get the security. And this is why it's important for you to understand that. Number two, no benefit from falling rates. That's a con. If the central bank or Bank of Canada cuts interest rates, your payment remains the same. You will not get a benefit for that. So you won't see any saving until your term ends and you renew. These are the cons. Number three, the higher interest rate, higher penalties for breaking the mortgage. For example, if you need to sell your home or break your mortgage contract early, that is for refinancing, the penalties are usually much higher than a variable mortgage. They are often calculated using an interest rate differential, which can amount to tens of thousands of dollars. So that is a cons of having a fixed rate, because the bank is charging you more money for providing you the security. So you understand this now. Number four, less flexibility. The fixed mortgage often have stricter terms and fewer options for prepayments or lump sum payments without incurring fees. They will charge you a fee if they want to give you a fixed rate. So these are the cons of having a mortgage, a fixed mortgage. Let's talk about now variable mortgage. We call VRM. A variable mortgage has an interest rate that can fluctuate with your lender's prime rate, which in terms moves up and down with the central bank's policy rate, like the Bank of Canada overnight rate or the U.S. federal funds rate. And it happened. There are two common structures in that. We're going to talk about that. Payment amount fluctuates. And this is where your payment goes up or down as the rate changes. And that's the beauty of flexibility that you want. But payment, if you are on a fixed income, you have a challenge. How are you going to manage that? And this is the risk that you discuss with your client, with your mortgage agent or broker. Second, the payment stays the same, more common in Canada. Your payment amount is fixed, but the portion going toward interest versus principal changes. If rate goes up, more of your payment goes to the interest and you build equity slower. That means you are paying, if interest rates goes up, you are paying more of the same amount toward the interest, not the principal. So it will take longer to pay off the principal. If rate goes down, more goes to the principal and you pay off your mortgage faster. This is our basic two structures in this. So let's talk about the pros and cons of variable rate mortgage. Number one, lower initial rate. The most compelling reason to choose a variable rate, you start with a lower interest rate, which means more of your initial payment go toward paying you down your principal. Okay? Potential for significant saving. That's another benefit. If the interest rates falls or remain stable over your term, you will pay less interest overall compared to someone with a fixed mortgage. And these are the advantage or pros on this. Number three, lower penalty for breaking the mortgage. And the penalty for breaking a variable rate mortgage early is typically only 3 months interest, which is almost always significantly less than the IRD penalty on a fixed mortgage. And this is very big difference between the two. Number four, more flexibility. Variable mortgage rate often comes with more generous prepayment privilege, allowing you to pay down your principal faster without penalty. That's variable. Whatever you borrow, that's what you have to pay back. And if you are able to pay back more, why not? Let's talk about the cons of a variable rate. Payment uncertainty and risk. This is the biggest disadvantage. If the interest rate rise, your payment will increase, or the portion going to interest will, because you will be paying more toward interest, not toward the principal, making your budget less predictable and your mortgage more expensive. Financial stress. The potential for rising payments can cause anxiety, especially for those on a tight budget. Watching the news for Central Bank or Bank of Canada announcement can become a nervous, wracking experience. Oh my God, interest rate is going up. It's going to impact our payment. What are we going to do? So this are the cons of a variable rate mortgage. Number three, budget challenges. It's harder to plan your long-term finances when your largest monthly expense can change with little notice. So we all are on a limited budget. Everybody has their own capacity, income that they are using, and they have expenses. And this is what I always said to all our clients. Please create a budget, a monthly budget, forecast for the whole year. What are you buying? And buying goods, food, gift, students' school fees, any medical expenses, recreation, trips, everything, car payment, insurance, home insurance, all those things to budget it. That way you know, but this will offset that if the interest rate rises. And that's why we are talking about this one. So what are the key considerations to help you choose? Idea is, shall I go with a fixed rate mortgage or do I go variable mortgage? So ask yourself these questions. What is your risk tolerance? That's the number one. Low risk tolerance. If the thought of your payment increasing keeps you up at night, choose a fixed rate. Simple. If you know the interest rate will go up and down and you can't sleep at night, go with a fixed rate. If you And this peace of mind is worth the potential extra cost if you end up paying for the fixed mortgage. Number two, high risk tolerance. This is very, very important for you to understand. If you are comfortable with some uncertainty in exchange for potential saving, because if interest rates are rising and you fix the rate, you will save. If you fix the rate and interest rates start going down, you won't save. But if you're comfortable with it, some uncertainty in exchange for potential saving, you can absorb higher payment if needed. A variable rate may be for you. And this is the determination you have to make. Ask yourself this tolerance question: low risk tolerance and high risk tolerance. Which way you can go? Key consideration to help you choose: what is the current interest rate environment? And these are the questions that you are making to yourself. Rates are low and expected to rise. This generally favors a fixed rate to lock in the low rate before they go up, they go higher. And these are the things that you have to understand: the environment, what's going on. Do due diligence. Talk to mortgage broker. Call my office, 905-785-9926. I will do a sit down with you and explain you everything. And this is why these programs are being presented, so you can read them and make informed decision. Number two, rates are high and expected to fall. Two things happen: either rates are going up or the rates are going down. And this is the environment of interest rate, current interest rate. So this generally favors a variable rate, as you can benefit from future rate cuts. And as you know, right now, rates are going down. It depends how long you want to keep your mortgage, whether it's going to be 1 year, 2 year, 3 year, whatever. What are your plans? To keep the house, dispose of size? You want to downgrade? You want to upgrade? Because as you know, I am a president and real estate broker record for City Pro Realty in brokerage. So I can talk about real estate. I'm a principal broker of Canada Express Mortgage and the owner. I can talk about financing because Canada Express Mortgage license number 13241. That's what we're sponsoring this event today. And also I'm a licensed builder with HCR Dixon Construction Inc. I'm the president and founder. So license number is B63247. And I can talk about real estate, financing, and construction. So this is important for you, that what is the current interest rate environment? And you have to talk about that very candidly with your broker. If you are not dealing with someone, you want to talk to me, call my office, 905-785-9926. I will sit down and explain you these things. Note, predicting interest is notoriously difficult, even for experts. You know, we can't predict that. What Bank of Canada governor will make the decision. He may disagree. You see those predictions on social media, and we do the education guess as well, but you don't know what happens. And this is why it's very, very important for you to think about that key consideration when you are making a decision. Again, key consideration to help you choose: what is your financial situation and future plan? This is a key. You have to think about that. So let's talk about that. Fix tight budget. If you are stretching to afford your home and have no room for a higher payment, fix is the safer choice. And this is again part of risk management. As under MBLLA, we have know your client and know your product. That means we have to learn everything about you when you are asking us to help you to finance that. We need to know all the risk factors and to make sure we discuss with you and you are capable of handling those. So fix tight budget. If you are stretching to afford your home and have no room for higher payment, fix is the safer choice. Stable, high income. These are your financial situation and future plans. Stable, high income. If you have a secure a job, significant saving, and your income can easily handle a payment increase, you can better afford the risk of a variable mortgage. So idea again is to see your risk capacity and your plan. And number 3, planning to move soon. If there is a chance you might sell your home before the term is up, the lower penalty of a variable mortgage can be a major advantage. That means you have to think about it. Are you planning to keep the house? Or you plan to near future sell it? Then you plan it accordingly and choose from. This is why we are talking about, in a layman terms, simple ways so you understand. Think about these things. Hybrid option, convertible mortgage. Many lenders offer the option to convert a variable mortgage to a fixed rate mortgage at any time during your term, usually at the then current fixed rate. One thing you have to remember that in the beginning, you are able to negotiate the deal. When you are on a variable mortgage, you already have agreed a signed contract to work with that lender. So if their fixed rate at that time offered to you a little bit higher, you may not have a choice. But there is an option. Until that fixed rate hike begins and you fix it, you are saving money under variable. So this gives you a safety valve. You can start with a lower variable rate and lock in if you become nervous about rising rate. I nervous because your circumstances will change depending on those things that we discuss in our chapter. Now, here is a chart, a table that I crafted for you. It's summary, give you summary. So these are the features: fixed rate, variable rate, interest rate, constant for the term. If you fix a term, fluctuate with the lender's prime rate, variable. Monthly payment, predictable and stable, fixed monthly payment under fixed mortgage. Can change, or the interest principal split changes with a variable rate. Initial cost, typically higher, typically lower. The risk protected from rate increases. This is the very, very important. And under variable, exposed to the rate increases. Automatically, the moment Bank of Canada increase rate, bank will automatically adjust them. Potential saving. Lower, you may pay for the stability because you want stability. You can handle the risk. Under variable is higher if rates stay stable or fall. Penalties, usually very high IRD. usually lower 3 months interest rate. They will go back and determine your rate, because if they give you a discounted rate, they're going to go back to the original rate. For example, if it was 5, when they give you discount of 3.5, they're going to bring back, they're going to give you differential interest rate from 5 and multiply number of years, number day remaining, and then they will divide into 3 and amount they were, because they're losing profit, interest, money they're going to make on you. So you will be paying a very significantly. I have already a program, a calculation on my YouTube channel, realtycoffeetalk.com. You can go and check that out. This program, more detail was shared in the past, and you can go to realtycoffeetalk.com, or you can go to YouTube at the rate of realtycoffeetalk.com, Realty Coffee Talk, and search for that. There are 515 episodes already there. The best is a budget conscious, risk adverse, first time buyers. So if you are cautious about your budget, you cannot handle the risk, especially the first time buyer, they're new in the market, they got the property. I recommend that you will go with a fixed rate. Variable risk tolerance is big issue. We have to determine that you are how much risk you can tolerate. We mentioned that in the earlier slide. Financially flexible, you are an individual because you have the capacity to accommodate any change in price. So this is an overall summary I try to explain you so you have an idea. So final advice, there is no universal right answer. The best choice depends entirely on your personal financial situation, your tolerance for risk, and your future plans. It is always wise to speak with a qualified mortgage advisor who can help you analyze your specific requirements. I'm a principal broker of Canada Express Mortgage and the host of Realty Coffee Talk. You can call my office 905-785-9926. I'd be more than happy to help you so you make informed decisions. Thank you for watching. I'm looking forward to your valuable feedback and collaboration. If you want to apply for a mortgage, you can go to online express-mortgage.ca. And this is the courtesy of Canada Express Mortgage Inc., license number 13241. Thank you for watching, and stay in touch. And I request you to please go to realtycoffeetalk.com and subscribe to my YouTube channel. There are 515 episodes to make you informed decision when buying, selling, financing, or building your home. Thank you for watching. Have yourself a wonderful evening. Bye for now.